Think about the most important technology companies in the world right now.
Right. Yeah.
I mean, your mind probably jumps to the massive software giants building artificial intelligence, or, the brands designing those sleek glass and titanium smartphones in your pocket.
Sure, the usual suspects.
Exactly.
Yeah.
But the counterintuitive reality is that the actual foundation of the modern tech economy isn't software at all.
No, it's really not.
It's a highly specialized manufacturing company based in Illinois, making microscopic parts out of precious metals.
Yeah, and their entire operation is so deeply tied to the physical world that, like, a single cargo ship getting delayed in the Middle East could completely derail their profit margin.
Which is wild.
Yeah.
So for you listening, the learner, our mission for today's deep dive is to bypass the typical financial jargon.
We are definitely not just reading a balance sheet today.
Right. We are examining a stack of fresh financial sources from yesterday, April 23, 2026.
Specifically, we're looking at the Q1 2026 earnings data and supplemental financials for Knowles Corporation.
And I have to say, playfully, we had to clear some serious market beat Cloudflare security verification screens just to access this raw data.
Yeah, lots of clicking on pictures of traffic lights and crosswalks.
Exactly. But it was worth it because, Knowles isn't a household name. You won't see them sponsoring a stadium.
Nope.
But their components are, well, they're the invisible string of the global tech world.
That's a great way to put it.
Yeah. Without their highly engineered microscopic parts, a $100 million defense radar or a state-of-the-art electric vehicle is basically just a very expensive, useless brick.
Pretty much. The numbers they released are fascinating, but only if we look past the top-line revenue and understand the physical machinery driving those figures.
Right. Okay, let's unpack this, because before we can even begin to analyze like a 15% jump in revenue, we have to understand what it is they're physically manufacturing.
Right, because they aren't making the electric vehicle itself.
Exactly. So what are they making?
They manufacture specialty electronic components. The four main pillars mentioned in the report are high-performance capacitors, radio frequency or RF filters, advanced medtech microphones, and balanced armature speakers.
Okay, let's slow down and translate that into the real world.
Sure.
You mentioned RF filters. In the context of the defense industry, which I know is one of their major end markets, how does an RF filter actually function?
Well, think of an RF filter like a highly trained bouncer at the door of a chaotic, overcrowded nightclub.
Okay, I like that.
Yeah, in a modern military scenario, the airspace is just flooded with electromagnetic noise. You have friendly communications, enemy jamming signals, civilian radio broadcasts.
Just ambient radiation bouncing around everywhere.
Exactly, all simultaneously. So a radar system or a secure military communication array needs to receive one specific, highly sensitive signal to track a target or get an order.
Right.
The RF filter physically blocks all the unwanted frequencies, all that noise, and only allows the exact required frequency to pass through to the receiver.
Wow. So if that filter fails or lets in interference,
The radar is blinded.
man, so the tolerance for error is essentially zero.
Absolutely zero. These are mission-critical components that enable technologies with the power to, change, improve, and save lives.
That explains the defense side. What about the electrification side? The report heavily emphasizes their high-performance capacitors for electric vehicles and green energy grids.
Right?
I know a capacitor stores electrical energy, kind of like a battery, but it discharges it much faster. Why can't an EV manufacturer just buy like a generic capacitor from a discount supplier?
Because a standard capacitor will quite literally melt under the load requirements of a modern electric vehicle.
Just melt.
Yeah. When you step on the accelerator of an EV, or when the regenerative braking system suddenly captures a massive spike of kinetic energy and sends it back to the battery.
The whole system just surges.
Right, the electrical architecture experiences this violent shift in power. So Knowles is engineering capacitors using advanced ceramics and precious metals that can handle those massive voltage spikes.
And extreme temperature variations, I assume?
Yes, and relentless vibration without failing. I mean, it is a completely different tier of physics compared to the capacitor inside, say, a household television.
That makes sense. Okay, then we have the med tech side. Advanced microphones and balanced armature speakers.
Yeah, that's a huge segment for them.
I want to drill into the balanced armature speaker because that sounds like serious audio engineering jargon. How is that different from the speaker inside my living room sound system?
Well, a traditional dynamic speaker, like the one in your living room, uses a relatively heavy electromagnet attached to a cone that pushes air to make sound.
Right, the typical cone you see vibrating.
Exactly. It takes up space and requires a lot of power. But a balanced armature speaker is entirely different. It uses a microscopic, incredibly thin metal reed that is precisely balanced inside a magnetic field.
Oh, wow.
Yeah, and when electrical current hits it, the reed vibrates without the need for a massive electromagnet. It is infinitesimally small, and it requires almost zero battery power.
And the audio fidelity?
Razor sharp, which is exactly what you need if you are building a modern hearing aid that has to sit invisibly inside someone's ear canal.
And run all day on a microscopic battery,
Exactly.
which connects directly to a phrase their CEO, Jeffrey New, used in the press release. He described their business strategy as customer application intimacy.
Yes, that's a key concept here.
They aren't just stamping out millions of generic parts and putting them in a catalog hoping an engineer buys them.
No, not at all. They are sitting in the room with the engineers at a medical device company or an aerospace firm.
Looking at the blueprint for a product that hasn't even been invented yet.
Right, and custom designing the exact microscopic component required to make it work.
And once they successfully design that bespoke component, Knowles uses its heavy industrial footprint to scale it into mass production.
Which creates an incredibly deep competitive moat.
Right.
I mean, once a medtech company integrates a Knowles balanced armature speaker into their FDA-approved hearing aid, they cannot easily swap it out for a cheaper competitor's part.
Because they'd have to redesign the entire internal architecture of the device.
Exactly, and go through FDA approval all over again.
So what does this all mean, like, for the financials? Let's transition to the actual Q1 2026 earnings, because the numbers here are genuinely blockbuster.
They really are.
Revenue hit $153.1 million for the quarter. That is a 15.8% increase year over year compared to Q1 of 2025.
And the context matters here because that growth actually exceeds the 5-year annual organic growth target they presented to their own investors back in May of 2025.
Right, they are running ahead of schedule.
But, you know, the top-line revenue is strong, but the bottom-line profitability is where the mechanics of their business model truly reveal themselves.
Right, the earnings.
Yeah, their non-GAAP diluted earnings per share, the actual profit generated for every share of the company, came in at 27 cents.
Which represents a massive 50% year-over-year increase from Q1 of 2025.
Right.
Wait, I have to ask. A 15% bump in revenue leading to a 50% jump in earnings per share makes no sense mathematically.
Unless something fundamental changed.
Exactly. Are they just using their competitive moat to aggressively hike prices on their customers? Or is there a deeper operational efficiency story hiding in these non-GAAP metrics?
Well, if we connect this to the bigger picture, you are looking at the textbook definition of operational leverage in a manufacturing environment.
Okay, break that down for me.
Think about the physical factories Knowles operates. A semiconductor or specialty component facility has massive fixed costs.
Right, the building, the machines.
You have to pay for the massive climate control systems, the precision robotics, the specialized labor, the raw materials just to turn the lights on. Let's say it costs $10 million just to run the factory before you sell a single part.
So the first million units you produce essentially go entirely toward paying off that massive overhead.
Precisely. But once you cross that break-even threshold, the math flips entirely.
The marginal cost to produce the 10,000 in first unit is incredibly small.
Exactly. Because the revenue grew by nearly 16% on higher volume, those extra millions of units flowing out of the factory doors didn't require building a new factory.
The fixed costs were already covered.
So a disproportionate amount of the revenue from those extra sales flowed directly to the bottom line as pure profit. The report cites higher volume, margin expansion, and lower interest expense as the specific drivers of this leverage.
That makes the GAAP versus non-GAAP distinction in the report critical.
Very much so.
Because the 27 cents EPS is a non-GAAP figure. For anyone unfamiliar, GAAP stands for Generally Accepted Accounting Principles. It's the strict, standardized way regulators require companies to report earnings.
Right, it's the official rule book.
And non-GAAP is the company's management, effectively saying, if you want to see how our actual daily business is running, you need to ignore these specific one-time or non-operational expenses.
Yeah.
What exactly are we ignoring to get to that 27-cent figure?
Well, the largest adjustment was $10.4 million in stock-based compensation. They also excluded the amortization of intangibles, which is just an accounting mechanism for writing down the value of non-physical assets over time.
Standard stuff.
But more importantly, they excluded the ongoing costs required to integrate their recent acquisition of a company called Cornell Dubilier into their precision devices segment.
Which is a completely logical exclusion. I mean, if you buy another company, you have a massive wave of one-time costs.
Oh, yeah. Paying lawyers, merging IT systems.
Physically moving factory equipment.
Yeah.
If you leave those costs in the quarterly earnings, it makes your core manufacturing business look artificially weak.
When in reality, you are just paying the bill for long-term expansion.
Exactly. But there is one metric in this report that instinctively sets off a tiny alarm bell for me.
Oh, what's that?
Their cash generated by operating activities in Q1 was actually negative $0.7 million. A highly profitable company bleeding cash from operations seems contradictory.
It looks contradictory until you map it to their historical production cycles. Q1 is inherently their lowest cash generation quarter due to seasonal working capital buildups.
Oh, so they're buying materials up front.
Exactly. They're buying raw materials and spinning up production lines to fill orders that will be paid for later in the year.
That makes sense.
And the management explicitly reaffirmed that they expect operating cash flow to hit between 16% and 20% of total revenues for the full year.
Which aligns perfectly with their long-term target.
Exactly. The cash engine is completely fine. It's just gearing up for the back half of the year.
Okay, let's look under the hood at the two specific business segments driving this growth to see where that operational leverage is really happening.
Right. MedTech and precision devices.
Yeah. MedTech and specialty audio had an absolute breakout quarter. Revenue hit $68.0 million, up 13.9%.
That's a solid jump.
But the metric that jumps off the page is their adjusted EBITDA margin, which grew by an astonishing 480 basis points.
Yeah, that is massive. And just as a reminder, adjusted EBITDA earnings before interest, taxes, depreciation, and amortization is the clearest lens we have into a factory's raw cash-generating power.
Before the accountants start applying tax strategies or depreciating old equipment.
Right. So a 480 basis point increase means their profit margin in that specific segment improved by nearly 5 full percentage points in a single year.
Wow.
The report attributes this to increased hearing health product shipments tied to successful new product launches by their customers.
And increased factory capacity utilization.
Yes, exactly.
That is the customer application intimacy paying off. Their engineers embedded Knowles components into a new generation of hearing aids, and when those became a hit, Knowles automatically captured the upside.
Exactly. And over in the precision devices segment, revenue grew 17.4% to $85.1 million.
And their adjusted EBITDA margin there increased by 260 basis points.
Right. The drivers there were broad-based end market demand and pricing power.
Which is the direct result of the moat we discussed earlier.
Yep. When an aerospace company needs a component that can survive the vacuum of space, they're willing to pay a premium. They aren't haggling over pennies the way a consumer electronics company might.
Okay, but here's where it gets really interesting. I have to push back on this massive margin expansion story.
All right, let's hear it.
If we look closely at the footnotes of this report, Knowles notes that they divested their consumer MEMS microphones business back in December of 2024.
Yes, they did.
MEMS stands for Micro Electromechanical Systems. Basically, they were making the tiny microphones that go into generic smartphones and smart speakers.
That's correct.
My understanding is that the consumer MEMS market is a brutal, high-volume, low-margin race to the bottom because everyone is constantly undercutting each other on price.
That assessment is entirely accurate. The consumer MEMS business was actively dragging down the overall corporate margins of Knowles. Shedding that business was a strategic move to exit the commodity game.
Right. So if you actively amputate the least profitable part of your business, your overall average profit margin is mathematically guaranteed to go up.
Mathematically, yes.
So is this 480 basis point jump in medtech margins mostly a mathematical ghost? Are they patting themselves on the back for operational brilliance today when all they really did was drop a heavy bag of low-margin business a year and a half ago?
It is a vital question because companies often use strategic divestitures to obscure underlying weakness. But the timeline detailed in the report disproves the mathematical ghost theory.
How so?
We're comparing Q1 of 2026 to Q1 of 2025. The consumer MEMS business was sold off in December of 2024.
Ah,
Therefore, the baseline metrics we were looking at from Q1 of 2025 already had the MEMS business removed.
the low-margin business was already gone from the comparison.
Exactly. We are looking at a pure apples-to-apples comparison of continuing operations. The margin expansion they are reporting today is newly generated efficiency. It is the result of running their factories at higher utilization rates, securing better pricing, and fulfilling a massive backlog of high-value orders in defense and electrification.
So it's real operational muscle, not an accounting illusion.
Completely real.
That distinction changes the entire reading of the report. So internally, Knowles is operating like a finely tuned machine, and their Q2 2026 outlook reflects that confidence.
That does.
They are projecting sequential growth, with expected revenue climbing to between $152 and $162 million, and non-GAAP EPS projected between 28 and 32 cents.
Strong numbers.
But no manufacturing company exists in a vacuum. A high-tech facility in Illinois is physically tethered to the geopolitical reality of the globe.
And this raises an important question about systemic vulnerability.
Right.
Because to truly understand the risks to this optimistic outlook, we have to examine the safe harbor statement included at the end of the press release.
Typically, a safe harbor statement is just a dense wall of boilerplate legal jargon designed to protect the company from lawsuits. Right. If their financial projections fall short.
Exactly. Normally, they just list vague risks like currency fluctuations or general market downturns.
But the safe harbor statement in this April 2026 report reads like a distress signal from a global intelligence briefing.
It really does.
They explicitly highlight the risks of raw material and precious metal availability. And crucially, they point directly to extreme geopolitical tensions.
Specifically citing the ongoing conflict with Iran and how it is disrupting maritime traffic through the Strait of Hormuz.
And the Strait of Hormuz is one of the most critical maritime choke points on the planet, right?
Yes. It is heavily utilized for the transport of global energy supplies, including liquefied natural gas and oil. And Knowles specifically notes that this disruption is contributing to sharp energy price increases.
This is the ultimate butterfly effect.
It is.
I mean, it is staggering to conceptualize how a maritime conflict involving cargo ships thousands of miles away in the Middle East poses a direct existential threat to the profit margins of a company making microscopic hearing aid parts in the American Midwest.
Right.
Walk us through the physical mechanics of that vulnerability.
It comes down to the physical nature of what Knowles builds. You cannot code a high-performance EV capacitor out of software.
You have to physically manufacture it.
Yes.
Yeah.
That requires raw physical inputs. Knowles relies on highly specific precious metals and advanced ceramics.
And the supply chains for those.
The global supply chains for those raw materials are heavily reliant on stable maritime shipping routes. If those routes are blocked or forced to reroute around entire continents.
The cost of raw materials spikes.
Exactly. And beyond the materials, there is the energy cost. You mentioned earlier that their factories use extreme temperatures to forge and bake these ceramic components.
Right, massive kilns.
Yeah.
That requires massive, uninterrupted streams of industrial energy.
Right. And when the Strait of Hormuz is choked, global energy markets panic. The price of oil and natural gas surges.
And that inflation bleeds instantly onto the factory floor in Illinois.
It suddenly costs exponentially more to power the robotic assembly lines and heat the kilns?
Oh, wow. So the operational leverage we praised earlier works in both directions.
Yes, it does. If the fixed costs of running the factory suddenly skyrocket due to energy inflation, the profit margin on that 10,001st widget collapses.
The report also notes that Knowles is carrying $90 million in net debt.
Right.
In a highly inflationary environment triggered by energy shocks, central banks are forced to keep interest rates higher for longer to cool the economy. That makes servicing debt significantly more expensive.
Yeah, they noted that lower interest expense was a driver of their Q1 success. But a prolonged geopolitical crisis could flip that tailwind into a massive headwind.
And if those input costs soar, Knowles is faced with a difficult choice.
They either absorb the costs and watch their 480 basis point margin expansion evaporate,
Or they attempt to pass those new costs onto their customers in the defense and medical sectors.
right, and even with their competitive moat, there is a limit to how much price hiking those end markets will tolerate before they start looking for alternative architectures.
The safe harbor statement isn't just a legal shield. It is the executive team explicitly signaling to the market, we have optimized everything inside the four walls of our factories. We are operating efficiently. But our entire business model is suspended on a fragile, global supply chain that we have absolutely no control over.
It is a stark reminder of the physical limitations of the tech economy.
Which brings us back to you, the listener, and why examining the Q1 earnings of this specific, relatively unknown manufacturer is so valuable.
Right. Knowles serves as a granular, highly accurate barometer for the broader state of global technology in 2026.
Because if they are seeing surging, backlog-filling demand across defense, medtech, and electrification, it is proof that massive multinational corporations are aggressively deploying capital into physical infrastructure and advanced hardware. It proves the secular trends are real, not just theoretical projections.
Exactly. By watching the flow of these microscopic components, you can map the macro-level movement of the global economy.
But the tension between their massive profits and their geopolitical vulnerabilities leaves us with a final thought to mull over today.
A provocative one.
Yeah. Throughout these sources, Knowles points to electrification, the massive societal shift toward electric vehicles, green energy grids, and battery infrastructure as one of their primary secular growth drivers.
It is a multi-trillion-dollar global transition.
But in the exact same document, they warn that fluctuations in the availability and pricing of specific precious metals pose a material risk to their operations.
Because without those highly specialized metals, you cannot build the high-performance capacitors that prevent an electric vehicle's power grid from melting down.
Right. So consider the implications of that dependency. As governments mandate the shift to green energy, we naturally assume the primary hurdles will be political willpower, consumer adoption, or the logistics of building millions of charging stations.
Right, the visible stuff.
But what if the true bottleneck for the entire global green revolution isn't policy or demand? What if the fatal bottleneck is simply a physical shortage of the rare, highly specific precious metals required to manufacture a single microscopic Knowles capacitor?
Wow.
If that invisible string breaks, does the entire global transition to electrification simply stall out on the factory floor?
The broader ambitions of global technology are entirely captive to the physical availability of its smallest, most invisible components.
Absolutely. So the next time you marvel at the silent acceleration of a new electric vehicle or the seemingly magical, invisible capabilities of a modern medical device, take a moment to think about the physical reality holding it all together. Keep questioning the invisible architecture of the world around you, the supply chains that feed it, and the factories that forge it. Because the real story driving the future is almost always hiding in the microscopic parts you can't see. Thanks for joining us on this deep dive.